To properly evaluate investment performance, we have to look past short-term market noise and examine outcomes over a full decade. Over a 10-year horizon, the structural differences between active and passive management become crystal clear. On the active side, fund managers handpick individual securities aiming to achieve targeted yields and downside protection. On the passive side, funds rely on rules-based algorithms to capture market efficiency and guarantee benchmark participation. While short-term market moves can easily mask performance flaws, a decade-long view strips away the noise. It forces us to measure whether human intervention actually adds net value once costs and structural mechanics play out over time. When we look at the historical data over the 10-year period, from 2016 to 2026, the broad market reality is stark. A massive 85% to 90% of active large-cap US and international equity funds fail to beat their benchmark indexes. In modern equity markets, information is priced in almost instantly, making it nearly impossible for human managers to maintain a consistent competitive edge. Furthermore, active funds suffer from a severe survivorship problem. Only about 25% of starting active funds survive and outperform over a decade, with a massive portion liquidating or merging away due to poor performance long before reaching the 10-year mark. For equity exposure, passive index trackers clearly dominate. However, the active versus passive debate is not entirely one-sided. There is a major nuance when we turn to fixed income. Passive bond indexes suffer from a structural flaw. They are debt-weighted, meaning they naturally allocate the most capital to the entities that borrow the most money. Active fixed income managers exploit this flaw by manually avoiding toxic debt, identifying hidden yields, and adjusting portfolio duration to protect against interest rate hikes. The data reflects this advantage. In fixed income, 45% of active funds manage to survive and outperform their benchmarks over 10 years, rising to 44%, specifically in corporate bonds. Bond markets are far less efficient than stock markets, creating genuine opportunities for skilled active managers to add real value. The single biggest reason active funds underperform over time comes down to fees, the silent killer of returns. Because active funds require expensive human capital, they start with an invisible handicap. They must beat the market by the exact margin of their fees just to break even with a passive index. Comparing an average index equity fee of 0.05% against an active equity fee of 0.64%, that fee gap widens dramatically over a 6 to 10-year timeline. In fact, cost is the single strongest predictor of whether an active fund will succeed. Within active funds, the cheapest quintile boasts a 57% success rate, whereas the most expensive quintile drops to just 27%. Lowering management fees remains the most reliable path to investor success. To build an optimal portfolio for the next decade, we can combine these lessons into a core and satellite framework. Your core should consist of passive equity index trackers that offer bottom-tier fees, giving you efficient, low-cost broad market growth where active management fails to add value. Around that core, you can place active satellite funds in complex, inefficient asset classes like fixed income and specialized yield strategies where active management actually yields results. When selecting those active satellites, demand low-fee structures and look for long-tenured management teams. By pairing low-cost passive equities with selective active bond exposure, you maximize growth while capturing true market inefficiencies. Thanks for microlearning with our channel. Be sure to like and subscribe for more updates.